Positive arbitrage in whole life insurance. I wanted to talk about this topic a little bit. This will again go under some of the classification of random thoughts. So, when we talk about the infinite banking concept, some people believe that the infinite banking concept is about positive arbitrage, meaning that today you run your cash flow through a checking account. First thing that happens is you get your income direct deposited into your checking account. It sits there for some period of time until you withdraw it, either to pay bills, to move it into savings, or to move it into investing or something like that. And the checking account really just gives you convenience. It's not giving you any other benefits. So, what we're proposing, at least conceptually, when we get to the practical details, the waters get a bit muddier. But conceptually, what we're going to be doing is instead of running our cash flow through this dumb checking account that gives us no benefits, and that participates in a banking system that doesn't give us much control, we are going to run our cash flow through our own private banking system, namely our specially designed cash value life insurance policies, where we're then going to store and utilize our capital. So instead of storing and using our capital from a checking account, a bank account, a savings account, we're going to store and use it from a whole life insurance policy that's designed for infinite banking. Sometimes that means you get positive arbitrage, meaning you deposit your money into your private bank by paying a premium into your whole life insurance policy. Again, we're talking conceptually here. Don't get angry with me. I know it's a premium payment, technically, not a deposit. I understand. But yet, it's interesting because the bankers are allowed to speak things that are not true when they call your JP Morgan Chase checking account a deposit, a direct deposit. That's not true. What's actually happened when you deposit your money into your JP Morgan Chase account is you've actually made a loan to the bank. So if we're going to be nitpicky about language, let's be equal opportunity here. I would argue the way that your cash value life insurance policy works is a lot more like what people think a bank actually is, or what a traditional definition of a bank actually would be, rather than what the banking system does today. But be that as it may, you pay a premium into your whole life insurance policy. Now you have cash value available to you in your policy. When you want to utilize it, you're going to borrow against your policy by taking out a policy loan and going and doing whatever you are planning to do anyway, whether that be purchase, invest in something, whatever it might be. Let's say you're earning 5% in the policy and the interest rate on that policy loan is only 4%. What that means is you're getting positive arbitrage in the policy. So you could continue doing that indefinitely, and the earnings in your policy would outstrip the interest being charged on the policy loan. Sometimes you can do that. Sometimes you do get positive arbitrage, but not on a guaranteed basis. Sometimes it'll be the other way around. Maybe you're earning 4% on the cash in your policy, but you're paying 5% on the policy loan. So you're not getting positive arbitrage. In the strictest sense of the word, in that scenario, you're not getting positive arbitrage. However, you are getting positive arbitrage if we expand the definition and understand. As an example, the total benefits we're getting in the policy outstrip the interest being charged on the policy loan. That's somewhat subjected to how you value the benefit you're getting from whole life insurance. And if you're new to whole life insurance, if you're new to the infinite banking concept, this probably won't make a lot of sense to you. So watch some of the more basic videos on my channel first, maybe read Becoming Your Own Banker by Nelson Nash, because I'm getting to a more advanced topic. You can get positive arbitrage when, as an example, you use a policy loan to finance an investment. So you borrow against your policy, let's say at 5%, and you use that to finance the purchase of a rental property. Now you're getting cash flow. Maybe you're earning 10%, or you're having cash flow that you're then feeding back into your policy to pay down that policy loan. Meanwhile, you never interrupted the earnings in that policy because none of the money ever left your policy. It all kept earning for you. That can be a great way to increase the returns, the benefits you're getting from your investments. What's happening conceptually is you're benefiting from the investment and you're benefiting as the bank that financed the purchase of that investment because all the money you use to finance that purchase is earning for you in the investment and it's safely earning for you in your whole life policy. And you can then rinse and repeat on that process as you feed the cash flow from that investment back into your policy. Your policy continues to grow, you're paying premiums into the policy, and you replenish your borrowing ability. And then when another good investment, a good rental property comes up, you can rinse and repeat on the process. That can be a great way of doing it. But I do think that the infinite banking concept is about positive arbitrage, but not necessarily in the strict sense. As Nelson Nash would say, it's not about interest rates. It's not like I have to make sure that the interest rate I'm earning in my policy is greater than the policy loan interest rate. And even that is a little bit muddy. Those will change over time. As your policy matures, the earnings improve because the costs in a whole life insurance policy are front loaded. And the older the policy, the better it's performing. But I do think you can get positive arbitrage in the following sense. These are a few thoughts I put together. First of all, the interest being charged on those policy loans is not an added cost. This is a very subtle concept, but it's important to understand opportunity cost. If I go and pay cash for something, I'm still paying interest. What I did was I gave up the interest I could have earned. You're always paying interest. You finance every purchase you make. Either you're going to take out a loan from a third party lender, like you take out a car loan. Now you're going to pay interest on that loan to the lender, or you pay cash for the car, in which case you gave up all the interest you could have earned on that money. In either case, you're paying interest. If we borrow against our policy, we're still paying interest, but it's important to understand that is not an added cost. There's a cost we have anyway. Once we understand that, what we can do is effectively discount the interest rate we're paying on the policy loan because that's an interest cost we have anyway. This is why they call it the discount rate in finance. I can discount that because it's a cost I have anyway. And what makes this subtle and hard to understand is that it's a hidden cost. Opportunity cost is a hidden cost. And the things, the cost, the pain in our life that we can see is the pain, the cost that we can more easily address. We see it when we're paying interest to a bank because we have debt. We can see that interest, and that interest payment gives us pain, so we tend to manage it better. But when we pay cash for something, we don't see the hidden opportunity cost. The infinite banking concept allows us to recover that opportunity cost. If I borrow from a third party lender, I'm paying interest to that third party lender. If I pay cash for something, I gave up the interest I could have earned. If I take out a policy loan against my policy, I'm paying interest. So in all three scenarios, I'm paying interest. What's the difference? The difference is if I take out a policy loan, I'm still earning on that same pile of capital. I'm still paying interest, but I did not give up the opportunity to earn on that cash. So it allows me to recover opportunity cost. So we can see now it actually is a net benefit to me, even if I'm getting negative arbitrage in the sense that I'm paying a higher interest rate on that policy loan than I am earning in the policy. What's happening is not that I'm paying more than I otherwise would have, because that interest is a cost I have anyway, but that I'm recovering some of that opportunity cost. The analogy I would use is a rewards earning credit card. If I go and buy something and I pay cash for it, let's say I pay $10,000. If I instead make that same purchase with a credit card that gives me 2% back, now I pay that $10,000, but I get $200 back. It's not that I'm earning a 2% return. It's not that I'm getting a negative 98% return. It's that I'm recouping some of the costs I would have had anyway. The infinite banking concept is the same way. So once we understand what that policy loan interest really represents, what we understand is it's allowing us to recoup at least some of the opportunity cost. And if we don't recoup all of it, we're still coming out ahead. So we get positive arbitrage in the sense that we're coming out ahead. Once we understand that the interest we're paying on that policy loan is not an added cost. It's a real cost that we have to manage, but it's not an added cost. It takes an invisible cost, opportunity cost, and makes it visible, which makes it easier for us to manage. And that, I would argue, is a good thing. What's another sense in which we're getting positive arbitrage? Remember, the earning on the cash value in the policy is not the only benefit we're getting from our whole life policy. We also get death benefit protection. We can place a value on that. If we didn't have that death benefit in our whole life insurance policy, we would have to buy a term life insurance policy, and we would have the cost of paying those term premiums plus the lost opportunity cost of not being able to earn on those dollars. Because remember, the dollars going into our policy are earning for us in the cash value. It's not just that we're recouping those term premiums, but we're also recouping the ability to earn on them. So you'd have to factor that in. Once you factor that in, let's say we were earning 4% in the policy, but we were paying 5% interest on the policy loan. Once you factor in the death benefit, maybe you're effectively earning 5% in the policy. Now, maybe you're at least getting even. Keep in mind what you're earning in the policy is compounding. The policy loan interest only compounds if you don't manage it. It's simple interest for a year, and then it would be added to the principal balance. So you can manage that too. The death benefit protection is not the only benefit, though, that we're getting from the policy. There's obviously the cash value growth, which is not exposed to market risk and tax free. There's the death benefit protection. There's long term care protection. So you can use that death benefit should you have a long term care need. And this is especially important as you reach retirement. You can also use it if you have a terminal illness. So there's a benefit to that as well. What would I have to pay for an equivalent long term care insurance policy? We'd have to factor in not only the cost of that long term care insurance policy, but the lost opportunity cost of not being able to earn on those dollars. Because again, the dollars are earning for us in the policy. Once we factor that in, maybe now we're really earning 6% in the policy effectively. So now we are getting positive arbitrage. We're earning 6% of the policy while we're only paying 5% on those policy loans. What about creditor protection? Your whole life insurance policy, depending on your state, typically comes with some form of creditor protection. That's important too. What would I have to pay for, as an example, a liability policy to get that level of coverage? What would that cost? I might have disability waiver premium on my policy, which is really a miniature disability policy. What would I have to pay for that if I paid for it out of pocket, right? When you stack on these benefits, estate planning, that's another benefit. Whole life insurance can be a great estate planning tool. It's saving me money elsewhere. It's giving me additional benefits. And once you factor all those in, what you find is you do get positive arbitrage once you place a value on those other benefits that you're getting. And those values are somewhat subjective to you. The wealthier you are, the more you probably value creditor protection because you're more likely to be the victim of a lawsuit, the more likely you're to be a target. But all of those do have some value. And depending on how you would quantify those values, you would have to incorporate that into the return that you're getting. So the money you've saved on premiums you would have paid on a term life insurance policy or a long term care insurance policy or a liability insurance policy, plus the lost opportunity cost of not being able to earn on those dollars. Because again, everything in the policy is earning for us. That's another sense in which we really are getting positive arbitrage once we factor in all these additional benefits we're getting in our policy. Another way in which we're getting positive arbitrage is when you consider the volume of interest rather than the rate, the volume of interest rather than the rate. If I'm earning 4% on a $100,000 principal balance, I'm going to earn more via volume than if I'm earning 5% on a $10,000 principal balance, just to give an obvious example. General financial prudence would dictate that you should have some amount of emergency savings, some amount of cash that you're never going to touch. Let's say for you that the number is $50,000. You need to have $50,000 in cash to feel safe as a business owner, to have as your emergency fund, your opportunity fund. So that's $50,000 that you're not going to touch. What that means is if you're moving your savings and your cash flow into your whole life insurance policy, there's always going to be $50,000 of cash value that is not borrowed against, that is not tapped. It could happen if you had an emergency or a great opportunity, but that would then only be temporary because then you're going to build that savings up again. You might temporarily need to use your emergency fund. You might temporarily use your opportunity fund when a great deal hits the market, but then you're going to build that up again during normal times. If you have, let's say, $500,000 of cash value, the maximum amount of policy loans you would ever have outstanding in normal times is $450,000. What that means is you're always going to have more earning for you in your policy, $500,000 versus a maximum of a $450,000 policy loan outstanding. And every time you pay a premium, your cash value increases. Even if you tried to keep the policy fully leveraged all the time, you couldn't exactly do it because every time you pay a premium, your cash value increases. You are going to be getting positive arbitrage if you're just following general financial prudence, in the sense that you're going to have more volume of cash earning for you in your policy than policy loans outstanding, assuming you're following basic financial discipline, having some emergency savings, having some opportunity fund. So again, you do get positive arbitrage by volume. Another thing to keep in mind is, depending on how you use those policy loans, the interest you're being charged could be tax deductible. I'm not licensed to give tax advice, but the general principle is if you take out a loan for business or investing purposes, that interest that you're paying is now tax deductible. If the interest rate we're paying on the policy loan is 5%, once you factor in that it's tax deductible in some cases, maybe the effective interest rate we're paying is actually only 4%. That's another way in which we could get positive arbitrage. If we're following the discipline of being an honest banker, what's going to happen is that we're going to be managing those policy loans. We're going to be at least servicing the interest so it doesn't compound, so it stays simple interest, and probably making some principal payments as well. So we're going to be earning compound interest on an ever increasing principal balance in our policy, while we're paying simple interest on a decreasing principal balance on those policy loans. If we're playing honest banker and we're following the process of being your own banker, what's going to happen is, by volume, we're going to earn more in the policy than we're going to pay in interest on loans outside of the policy, simply through following the process of banking. Another thing you'd see happen is, over time, hopefully your income, your assets, your net worth is increasing. So your ability to service those loans becomes easier, but you didn't give up earning on anything in the policy over time. So there are definitely scenarios in which we get positive arbitrage, but we don't get it on a guaranteed basis in the strict sense. But again, we have to dig a level deeper. We can't just look at the interest rate on the policy loan versus what we're earning in the policy, which, by the way, what we're earning on the policy is much muddier than that. It's not just here's the interest rate you're being paid. You can back into the long-term interest rate that I effectively earn. Chris Kirkpatrick and I went through a video where we showed 36 years of actual performance on an actual Mass Mutual policy where the earnings in the policy were 6.13%. 6.13%. Keep in mind that's net of fees, net of taxes, net of everything. We have to keep that in mind too. When people talk about the earnings rate, they're usually talking about a gross number. If you earn 8% in an investment account, there's probably taxes you're going to pay on those gains. There's probably fees being charged, even if it's an index fund. Even if you have the money in a savings account, it's typically going to be taxable. So the rate that you're comparing is gross, whereas what we're earning in the policy is totally net. But we do get positive arbitrage at some point in time, and there are various things that we can do to maximize that ratio in our favor, but there is no free lunch. It's important to understand that, because sometimes people think that they're getting a free lunch by not doing infinite banking, and therefore they're avoiding the cost of taking out a policy and they're avoiding the cost of paying interest on a policy loan, but they're not avoiding those costs at all. There's no free lunch. You're going to incur those costs one way or another. Interest costs, even if you pay cash for everything, you will incur those interest costs. The cost of becoming your own banker, you will incur those because someone is going to be doing your banking for you, and that someone is going to be charging you, whether directly or indirectly. When you take out your free bank account, we all know the banks are profitable. So you are still paying for those banking services indirectly. Whereas if you become your own banker, yes, you still have those costs, but it's not an added cost. And now those costs are more visible to you. So these are just some ways in which we do get positive arbitrage in our whole life insurance policy once we account for all the various factors, once we ask the question as compared to what, there's no way to get around paying interest. Once we understand that, we understand why we can effectively discount the interest rate we're being charged on the policy loans. But I hope this was helpful. We'll talk again soon. Bye bye.